All right, time now for Futures in Focus. Joining us, Julian Emanuel, BTIG Chief Equity and Derivatives Strategist. Nasdaq futures definitely in focus last night when everything was going down. Julian, what is the market telling you today?
Well, if you look at it and going back to last night, Alex, even when the market was trading choppily, Nasdaq futures retained their bid. Basically, the message was that we were figuring out during the night that the Senate was going to remain in Republican hands. Therefore, no new corporate gains tax hikes and, a very tax-friendly structure in Congress. And so the winners, the year-to-date winners, NASDAQ, bid. The other standout for us is healthcare. We think healthcare is a huge part of today's story, and healthcare is trading at an extreme historical multiple discount because of the fear of politics that we think is not only discounted, but over-discounted.
Julian, I just have this sense that the equity market just wants to go higher. Coming into the election, the narrative was that a blue wave would be great because we would get loads of stimulus and the US economy would really benefit from that. Now the narrative is we've got divided government and that means no new taxes. The market seems to be kind of retrospectively fitting the narrative to the price action because the price action is that we want to buy stocks here. Is that an unreasonable thing to say?
So certainly, you would be disputing the tape today if you did say that. But I would step back for just a moment and look back. Factually, the markets topped on September 2nd and really that NASDAQ blow-off and have been correcting both in time and in price, more sideways with zigs and zags ever since. And so, basically today's rally takes us to the middle towards the upper end of the range. And from where we sit, the message of the markets is definitely mixed today because when you look at yields in particular, on the one hand, the decline in yields is saying, okay, big spending may not be in our future. But on the other hand, yields declining may also be saying, look, the reality is that we have a threat to the economy in the fourth quarter and the first quarter of next year because the virus is accelerating.
Mm-hmm. So, Julian, how are you hedged then? How do you protect yourself or deal with that while we're waiting for this uncertainty to shake out?
So this is one of these times, again, where because volatility is still as high as it is, you don't necessarily want to go the straight options route. For us, it's really sort of picking your spots and perhaps lightening up on new winners. And again, you see strength in NASDAQ. Today, really is an opportunity to lighten up on some of those winners because, frankly, we don't think that the correction and the positioning that became so extreme into September, we just don't think that story is over. And it really doesn't even matter what the political lay of the land ends up being, which, of course, we don't know.
Julian, we've gone 36 on the VIX to 28 now. The short end of the term structure repricing. Do you carry on being short vol?
I think you can very selectively. Again, when you think about it, our view is that particularly if the president is adamant about contesting it or the clarity of the presidential outcome is not resolved in sort of days or weeks or what have you. And again, the backdrop of the virus, that sort of argues for a bit of downside, but it isn't likely to be, emphatic, incredibly volatile downside simply because, again, we're going to find out tomorrow the Fed is there to cushion that downside.
So where is it still cheap to hedge?
I would say that, out to year end is okay, basically, given the degree of risks. It isn't cheap. And generally what you need to do is think about selling some upside call options against any downside that you might own. But again, this is one of these times where, as an investor, you have to think about how you're going to feel if this ends up being sort of a fake breakout and we start drifting, 10% lower or so, which in the realm of an environment where the VIX is 28 or it's 30 is just a run-of-the-mill correction.
Julian, we've got the Fed tomorrow, payrolls Friday. Do either of those two events matter to this market?
Yeah, I think they do. The risk here is the Fed reinforces this narrative that they're lender, not spender, and there may not necessarily be that much more that they can do. And I would look for Chair Powell, if he starts harping, which he's done, and we think correctly over these last several months, harping on the need for more fiscal stimulus. That's really body language that tells you that, yes, the Fed can buy assets, but in the final analysis, the challenges the economy faces over the next 3 to 6 months are much better handled by direct fiscal stimulus, particularly to small business America.